Hello once again. I'm experimenting with a shirt and a tie today, looking for new demographic niches. Let me know what you think. Okay, let's get focused. We're nearly done. And I'm going to spare you the details of going through all the audit procedures for each transaction cycle. I'm hoping that the explanation in the previous lessons on the sales cycle will give you a foundational level of understanding that you can apply regardless of the account or the assertion of interest. In this lesson, we're going to skip ahead to the audit completion procedures. These are the items that we need to perform to address other disclosures or accruals that are not picked up elsewhere. They also tend to be items where we can rely on as much hindsight as possible to get our conclusions correct. After all, our report doesn't usually come out until a couple of months after the year-end date. So it behooves the auditor to perform procedures using as much of the subsequent information as possible to the extent it allows us to substantiate those year-end balances. One type of area that requires significant judgment is contingent liabilities. A contingent liability represents a potential future payment of which the outcome and the amount are uncertain as at the year-end date. Some common examples include lawsuits, tax disputes, and guarantees provided to others. These sorts of contingent liabilities give rise to financial reporting issues in the form of recording provisions and incremental note disclosure. Procedures performed by the auditor for contingent liabilities include, first of all, making inquiries of management. There is a standard checklist of questions to ask where the auditor and the CFO sit down and have one last closing discussion. Secondly, reviewing any correspondence on such matters. For example, notices of assessment or reassessment from the tax office. Thirdly, reviewing minutes of board meetings. Board meetings are often where the really good stuff gets debated. Fourthly, analyzing legal invoices, as these often reference pending matters. And fifthly, sending a legal letter to all the lawyers in which the company has a relationship. Now, legal letters are a standard procedure for auditors, and the lawyers have a prescribed format for responding. The legal letter will confirm the existence of potential claims, the nature, the status, the amount, and the likelihood of loss. So that covers off contingencies. The auditor also needs to consider subsequent events. And you should remember that there are two types of subsequent events. And the first is those events that have a direct effect on the financial statements and require adjustment. For example, perhaps we have a valuation concern over a particular asset, and if that asset is sold subsequent to year-end, then we might be able to use the sales price as evidence of the valuation at the year-end date. The second type of subsequent event is those that do not have a direct impact on the year-end financial statements, but for which disclosure is required. For example, if one of our clients' hotels burned down after the year-end date, but before our report is released, this should be disclosed in the financial statements. The procedures for identifying subsequent events are similar to those used for contingencies, so auditors will conduct the two simultaneously. Additionally, the auditor may look at internally prepared financial statements subsequent to the year-end date to identify any potential issues there. The letter of representation is one of the last pieces of evidence that is gathered by the auditor. And this letter typically is prepared by the auditors, but it's written as if the client wrote it, and it is printed on the client letterhead. This 6 or 7-page letter basically summarizes all of the material representations made by management throughout the audit. It's signed by the CFO, the CEO, and sometimes even the controller. It's not the strongest piece of evidence available, but it is considered a standard audit procedure, intended to reinforce to management the representations that they've made to the auditors, either explicitly or implicitly, through the financial statements that they have prepared and represented. The final review of the file will be conducted by the engagement partner. For high-risk engagements, a second partner or technical review partner may also be brought in to review some or all of the audit file. The ultimate question is whether sufficient appropriate audit evidence has been gathered to support the auditor's opinion. One key consideration will be to review the accumulation of the unadjusted misstatements. Now, different firms call this worksheet different things. For example, I've often heard my auditors referring to this as the SAD, the Statement of Audit Deficiencies. Auditing is full of wonderful acronyms that only make sense to those in the secret auditors club. But there's no secret handshake that I know of. Anyway, The point here is to review the misstatements that have been accumulated throughout the audit fieldwork and make an overall comparison against materiality. Are you shocked that the auditors would find any misstatements at all? You shouldn't be, as this is very common. The auditor needs to keep in mind any carry forward errors from last year that would impact this year's numbers. This is often a point of confusion for new auditors, so let me explain by way of an example. Let's say that inventory is overstated by, say, $100,000 at the end of last year, which, by the way, would mean that our gross profit last year was overstated by the same amount. This error will carry forward to this year and should reverse itself when the inventory is sold. So when this overvalued inventory is sold in the current year, that will increase our cost of sales, which will understate our gross profit. So do you see how these opening errors can reverse? Next, we have disclosure checklists. And disclosure checklists are horrible things that can literally go on for hundreds of pages. But their purpose is to simply ensure that everything that should be disclosed in the financial statements has been disclosed by the client. Which brings us to the final evaluation. And during the final evaluation, the partner will review all of the work performed by his staff. And there are basically three reasons for this. Firstly, to evaluate the performance of inexperienced staff, i.e. the junior auditors fresh out of school. I told you the partners didn't trust you entirely. And remember the GAS standard that we talked about way back in the beginning of the course? The one about supervision of staff? Well, now you see its relevance. Secondly, to make sure that the file meets the firm's standards, not to mention GAS and CPAB and the PCAOB. And thirdly, to counteract the bias that can creep into the auditor's judgment. The audit fieldwork staff spends a considerable amount of time working with the client, and this is offset by the partner's independent review of the file. At this point, the partner will prepare review notes and get these sent back to the audit team to clear. Now, your goal as an auditor is typically to receive back as few review notes as possible. Some review notes are easy to clear, say for instance asking you to document your work better, or perhaps asking for clarification on a particular aspect of the file. Other review notes may require you to return to the client's premises and conduct more extensive procedures, which is really a pain in the ass. The final steps of the audit are to draft the auditor's report, the management letters, and prepare the communication to the audit committee. Now, the communication by the auditor to the audit committee will contain a summary of the major issues they've had to deal with throughout the course of the audit, as well as their concurrence or their disagreement with management on these matters. The auditors will typically list any significant but not material misstatements that they have identified. And finally, the auditors will identify any matters that remain outstanding as of the date of their presentation. The auditor's report will only be released when all the items have been received and the board has approved the financial statements. So finally, we have finished our audit. Woo! If you're one of those brave souls who has watched all 28 videos in this course, that's freaking awesome. I wish I could figure out a way to let you print out a certificate of completion or give you a gold star or something. Very well done indeed. Auditing is not everyone's cup of tea, but it can be a highly rewarding long-term career in and of itself. However, even more importantly, it's my opinion that auditing is an excellent foundation for any career in finance. I look back at my experience that I had as an auditor as one of the keys to my success during my career. The skills I learned as a public accountant are still relevant today with my work as a member on various audit committees or in various CFO roles I have held through the years. I'm fond of the expression that it's the other side of the same coin, so understanding both sides of the coin only enhances your value as a financial professional. So, if you have the opportunity to get public practice experience, I encourage you to take it. You'll thank me for it later. That's all for this course, so until next time, don't stop to get to the top. When you get to the top, don't stop.